In for Emily Chang, and this is the best of Bloomberg Technology, where we bring you all of our top stories from this week in tech. China put some of its largest cities on lockdown over the coronavirus. As global markets trembled on the news, we'll hear how investors are dealing with the uncertainty. Plus, a week of firsts for Alphabet, the first earnings report since Sundar Pichai took over, and the first time Google reported YouTube and cloud results. We'll have details. And Tesla's hot start, the EV maker is tearing through 2020 despite a couple of dips. We'll look at what's supercharged the stock up to this point. But first, our top story, all about concerns over the coronavirus, and it dominated headlines this week as the death toll continued to rise. Residents in the Chinese city of Wuhan have been quarantined, and some flights in and out of some parts of the country have been suspended. But this week also saw the return of risk appetite. Copper, for one, rebounded after a 14-day sell-off as investors bet the global economy will be able to withstand the impact from the virus. U.S. markets rallied the most since August, with the S&P back to record highs. Amazon closed above that $1 trillion market cap for the first time, joining the 13-digit club, with shares surging in the wake of a blowout earnings report last week. On Tuesday, my colleague Paul Allen and I were joined by Michael Purvis of Talbot Capital.
There's no question that the momentum, the underlying trend in momentum for risk assets has been very, very strong. You know, just to put some context on that, it was only a few months ago, back in September, when we had the bond market sort of signaling a recession was coming in 2020. And even though the bond market has clearly been still very supported, this concept of a recession narrative, both domestically and further economic contraction overseas, is really fading there. So you can check a lot of risk on boxes right now, for sure. And, you know, obviously the Fed has been there, and the liquidity is strong, as, you know, many people have commented on there. So, you know, people are wanting to sort of seem to, you know, the resilience of this rally has been very, very strong.
Michael, if anyone owns volatility analysis, it is you. What do you make of a VIX at a 16 handle today, down from an 18 handle just yesterday?
Well, it's funny. I think the VIX curve right now is very flat. You know, we're not seeing, you know, given how strong the lift higher today was in equity levels, you might have expected to see a bigger contraction there and a resteeping of the curve. I think looking out, though, into the future, the VIX has a few things on its mind right now. One of which is that the coronavirus news flow can ebb and flow and all that. But I think there's also a view that there is a sort of, you know, looming political risk, as some of your colleagues were just commenting on with what's coming out of Iowa and so forth. It's very hard to sort of contextualize and price that risk, but it certainly, that's coming. I think the other issue that the VIX market may be focusing on is that the 3250 level on the S&P is an interesting level, because that's a point where a lot of the dealers, the investment banks, have you know, what we might call a gamma pivot. In other words, they might be forced to sell the market if the market were to plunge beneath that level there. So, you know, right now that's, you know, the market's been very resilient here. But I think the idea about seeing some major, you know, realized volatility ticking up here in the near term is going to be different. It feels a lot different than, say, January of 2018 in that respect.
Michael, on the subject of volatility, I just want to bring up this chart on the Bloomberg here. We did, of course, see Chinese equities selling off heavily when the markets reopened after the Lunar New Year break. But now offshore investors absolutely piling in, buying those dips. My question is it too early? This crisis isn't over yet.
No, I know. You know, it's funny. I think my way of comparing these types of the coronavirus and what it means for the markets, it's a little bit similar to you know, natural disasters that are very, very large scale, or for that matter, terrorist events, where there's a lot of headlines. There's a lot of fears about how that's going to impact the economy and the markets. But usually those things, you know, sort of fade. And what we've seen, if you actually measure how the stock market reacts to terrorist attacks, for example, it becomes increasingly resilient and is increasingly capable of throwing this off. Fortunately, we haven't had a terrorist attack in some time there. But I think there's an analog there for viral outbreaks. Let's hope that we don't get more of these in the future. But I think there's a reasoned case to think that we might. And if so, can the markets just really look at this as a deferment of growth, as opposed to anything that's really going to be permanently impairing economic growth? And I think that seems to be what the narrative is. I have my own near-term concerns about the market, but they're probably less to do with the coronavirus.
Oh, okay. Well, I'll get to you to expand on those. What are your near-term concerns?
Well, it's just simply, it's very simple, really. It's just if you look at the trajectory of the tech stocks, not just semis, but the big cap tech stocks, the QQQ, the XLK ETFs, those have been leading and defining the rally. I've been structurally bullish on big cap tech for lots of reasons for a long period of time, and I continue to be so. But right now, given the strength and the magnitude of the rally that we've had over the last 5 months, I think simply think they're overextended, and some form of consolidation I think is inevitable. And I was sort of waiting for the big cap earnings to come in. I didn't expect them to be bad, and nor did I think they were going to be amazing. I just thought that it would be an event to kind of like, okay, we get it, they're good. These companies continue to generate very high quality and a nice quantity of earnings growth, but that would be a trigger to start taking some gains here. That happened just as Corona was sort of unfolding, and so it's a little bit hard to measure it all. But I would argue to you that even if Corona never happened, that there would start being some, the upward momentum in the tech shares was really going to continue to fade. And if you look at various technical signals on tech shares, you'll see that a lot of the upward momentum is going. So to my question is just, do we have a horizontal consolidation or more of a vertical or price-based consolidation over the next several weeks? But these X's, the market needs to process those and digest them.
Michael, you talk about vertical, and a stock that's gone from parabolic to vertical is Tesla. We'll be speaking with the fundamental analysis in the next segment. But from your position, more on the technical side, how do you play Tesla right now? Do you buy the underlying? Do you go via options? I'm thinking puts and calls. Or do you stay out of it because it's gone from parabolic to vertical?
Well, it's been just unbelievable there. I think, look, just the puts are very expensive. The implied volatility is jacked up, but actually relative to the calls, I think the put-call skew inverted on Tesla this morning, which is very rare to see that. In other words, calls were bid were richer than the puts were. Their timing is everything on a shorting Tesla. There will be a spectacular short at some point, and maybe that's tomorrow morning. Who knows? There, but I think it's, and I think some of your colleagues have commented. Luke Howe has commented on Tesla and some of the dynamics going on with the options market there. But I would just simply say this: I think one of the things about Tesla that I find just intriguing is that it's both sort of has this technology component to it, clearly, and yet it's also a sort of a new-fashioned industrial company. And ultimately, I think when you have those types of business models that are kind of ultimately asset-heavy, but have some aspects of transformational nature, the ability for the cost of that capital to be mispriced is very, very high there, because you're just simply dealing with a different type of return on investment than, say, Facebook or Google or some of these other, established tech giants are dealing with. And so I think that's going to be one of these themes where they're twice the market cap of General Motors and Ford and so forth. I think I can't help but wonder whether they're going to pull an AOL Time Warner, meaning that the company with the richly priced stock will merge with an old-fashioned auto manufacturer at some point, which has established cash flows and established 100 years of history. Who knows? I won't play M&A banker here, but I'm just saying that I think there's, the Tesla short thesis is one of those things where it's the ultimate sentiment stock, and so you have to be extraordinarily disciplined with shorting it, even if all the fundamental checks you can make are sound.
That was Talback and Capital's Michael Purvis. And coming up, we dive into the week's tech earnings. Alphabet shares wiped out their best gains since July. After the company's operating profit missed Wall Street estimates, we break down the numbers next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Tech earnings continued this week with Alphabet kicking off the action on Monday. Revenue from that key holiday quarter missed Wall Street estimates, suggesting the company's Google advertising business is struggling to maintain growth in the face of rising competition. We broke down the numbers with Bloomberg Technology's Mark Bergen.
They started off the call, and someone from Goldman Sachs was like, "This is the best call ever," because they made that disclosure. And so these are monumental disclosures for the company. Just the fact that they're opening up and there's new transparency, certainly in the cloud business. And we saw a lot from the CFO Ruth Porat and the CEO Sundar about the cloud business and the optimism there. And it grew over 50% this past year. They said this is largely the cloud storage, which competes directly with AWS as a market leader. That they said has been the biggest growth, even bigger than their sort of G Suite products. You saw a little enthusiasm for YouTube, but they talked a lot more about sort of both the potential market that YouTube has in digital advertising, as well as some new ways to make monetization, whether it's paid subscriptions or sort of commerce. Because some of the YouTube ad numbers fell below some of the estimates that were out there.
Well, and we got some comments from the CEO, Sundar Pichai, on YouTube's growth. Take a listen.
You may have seen a blog post today about our work to promote authoritative content and remove misleading information about the upcoming 2020 elections. For example, we are applying our deceptive content policies to reduce misleading information about voting locations or the census process. As I mentioned earlier, we are pleased with YouTube's growth in advertising and subscriptions.
Is YouTube as big as we thought it was?
It depends on who we were, right? There were some estimates that had revenues for 2018 at $20 billion. That was RBC. So the numbers they just disclosed were for advertising, and they talked about a run rate for the subscription around $3 billion. So even then, adding that up, that doesn't hit the $20 billion. That was for 2019. So there are other estimates that had it much higher optimistic. You know, there were some estimates that the whole business was worth $300 billion. Clearly, these numbers are not there. It's an impressive growth rate, and certainly, you know, they talked a lot about how they have this big addressable market with advertising. And I think, you know, to Sundar's points here, they still have some things to figure out on both regulation and brand safety to make advertisers comfortable to continue to have that growth.
That was Bloomberg's Mark Bergen. Meantime, Qualcomm came in with a strong sales forecast, beating estimates, and that's thanks to its belief in 5G networks. But CEO Steve Mollenkopf says the fiscal third quarter will be flat from the second. We discussed all of this with Bloomberg Technology's Ian King.
We had a nice report. Everything was up, everything was positive. Then on the call, actually, it was the CFO says, well, we're not so sure about the third quarter. It's going to be sort of flat. Tried to say that was seasonal, but really, if you looked at what the analysts were expecting, they wanted things to be linear up and to the right throughout the rest of this year. And clearly, as soon as that expectation was kind of confounded, then the stock went down quite severely and quite quickly.
We were speaking with Mike Walkley of Canaccord Genuity at the last hour, and I was asking him about that. If the third quarter is flat relative to second quarter, is the fourth quarter growth pick up enough to reverse some of the annual sales declines that we've seen? He seemed to think it was enough, but is there still some concern about getting that type of growth that the analysts were really looking for? Yeah,
I mean, you know, you've got the right context. They've had several years where we haven't had any growth. They've had several quarters in a row where they haven't had any growth. And really, investors are, you know, when is this going to finally pay off? When are we going to see the old Qualcomm come back? Anything that causes a little bit of a concern about that is a major, you know, you're pressing all of the buttons that people have been worried about for a while. In theory, though, they're saying the fourth quarter, when we'll see some new phones out there, some expensive things, that's when people will start to really get excited. That's when things take off.
The equity price, though, Ian, has had a pretty good year, up about, appears to be around 40%. And when you consider that 5G is going to be a long-term growth driver for Qualcomm, is this just a time to get long and hold on?
Yeah, I mean, I'm not in the business of giving investment advice, obviously, but no, I mean, you make a very good point. Chip companies in general have had a huge run-up in their stocks. We've seen a lot of companies, you know, they're trading at pretty high multiples. It's one of the hottest sectors in the S&P last year. So really, if you're a chip company, you're coming out and reporting, you better be saying something that, you know, at least meets expectations or exceeds them if you want to justify that price.
That was Bloomberg Technology's Ian King. And we also got reaction from Mike Walkley. He's the managing director of Canaccord Genuity.
Yeah, I think the key takeaway for the call is how 5G is going to be beneficial to Qualcomm's model. The real positive point from the call is for the March quarter guidance or their Q2 guidance, the revenue per MSM or the revenue per chipset going into these 5G phones. That revenue is going up 30% sequentially, which is one of the biggest jumps we've seen in our 20 years of covering Qualcomm. Stock's off a little bit in the aftermarket because June quarter guidance was flat with March. But if you look at the cadence of the smartphone market and the timing of Qualcomm's second generation modem, the X55 for 5G, that kind of starts shipping late in the June quarter, they did indicate they expected another big step function in their revenue starting in the September quarter, which would also be the first time they're shipping back into Apple in a couple of years now that they're back in Apple for Apple's upcoming 5G phones.
So does the pickup in their fourth quarter, even though their third quarter is flat, enough to take us out of what has been 5 straight years of negative sales growth?
Oh, yes, I think you'll start to see positive sales growth. The big driver is, you know, Apple is a large part of the smartphone market, you know, right behind Samsung in terms of one of the leading smartphone vendors in terms of volume. Qualcomm used to ship to them, and then they moved to Intel, and that really hurt Qualcomm's ability to grow. Now that 5G is coming and Apple's moving back to Qualcomm, that's going to really help them return to growth. So you should see very strong year-over-year growth for Qualcomm starting in that, you know, even that flattish June quarter gives you year-over-year growth. It gets much stronger into the September, and they hinted at a very strong fiscal 21. So I think as you go to the December quarter and beyond, which is the full volume of Apple into the holiday season, you'll see very strong reacceleration of Qualcomm's year-over-year growth, and that's why we like the stock and have a buy rating on it.
That was Canaccord Genuity's Mike Walkley. And the earnings parade continues after the break with fourth quarter results from Uber. We'll find out how the ride pricing and company's food delivery business are affecting the bottom line. Details next. Plus, Twitter also out with surprising results. We'll discuss the numbers with the social network's chief financial officer next. This is Bloomberg. It was a better than expected quarter for Twitter. It beat estimates for revenue and the number of new daily users. Twitter gives credit to product improvement and more personalized content. It now has 152 million people logging in daily on average. That's 21% more than a year ago. I got details with Twitter CFO Ned Siegel.
We're so pleased with our daily active usage growth that we delivered this quarter. 21% growth means that we are making it easier for people to find the things they're looking for. We're allowing them to follow topics, not just accounts. So you don't have to know who you want to follow if you care about the San Francisco 49ers. You have to know you want to follow the 49ers, and then we do the hard work for you. There's so much more room for us to improve on that, but we had 1,700 topics you could follow across 6 languages at the end of the quarter. That's a great example of some of the things that we've done, but there's so much else that we've done as well.
What's been the biggest challenge behind some of those product improvements?
Well, if you go back a few years, Twitter wasn't as good at moving fast, at testing, at having the confidence to try new things. There were more sacred cows around the product experience than there are today. And we're much more comfortable moving faster and trying things, whether it's allowing people to move quickly back and forth between a chronological and an algorithmic timeline, or these changes that we've made to allow people to follow topics. We're just getting better at moving faster.
There was some concern given Alphabet and Facebook had seen a little bit of a deceleration within the U.S. ad business. I know you're smaller, so it's not necessarily apples to apples, but how are you still getting the type of big U.S. ad growth numbers that you wanted to see?
Well, launching new products and services and connecting with what's happening are really resonating with advertisers. Whether it's Disney Plus launching on Twitter in the fourth quarter, which we were so proud to be a part of their launch. There were 9 million tweets about Disney Plus in the fourth quarter where people were talking about, forming opinion about, and engaging around a new and really strategic service for an important partner for us. Or the Super Bowl on Sunday, where 40 of 41 eligible advertisers who had ads on during the Super Bowl also were advertising on Twitter at the same time, launching new products, connecting with what's happening. Those things really resonated in the United States.
And within the ad business, you're not participating in political ads, but you still want to see engagement from that. How much incremental growth can we see given it is an election year, even though you are not participating in the political ads?
Elections are great times for Twitter, and it's always an election year on Twitter because 600 million people voted in India last year. There were nationwide elections in Japan, multiple times in the UK, and many other places in the world. We're able to test and learn and apply those learnings to other parts of the world all the time. We label the candidates in the United States now so you know who's tweeting. We are removing more spammy and suspicious behavior proactively. Bystander reports are down 27%. When you do these things and you organize the information better, then people can trust what they see. They feel safe being a part of the conversation. So elections are a terrific opportunity for us to showcase all the improvements that we have and improve audience.
RBC's Mark Mahaney said that they finally are getting the type of investment that they want to see out of you, that maybe you had underinvested in previous years. Some of those underinvestments led to the bug last quarter that led to personal data being used to target via ads. Are you confident that that bug is fixed, and does it have an impact on any results now going forward?
Well, we had ad settings that were not working as expected, and we fixed it quickly and announced it to people so that they knew what had happened and then worked to remediate it. The remediation really takes a few different forms. One is some stuff that we shipped in the fourth quarter to share aggregated, anonymized data with measurement partners. But as we move past that, there are two areas that are much more important. One is to continue our work on a new mobile application promotion ad format, which is important because it's an existing format, but it's also important because it gives us a better path to more direct response advertising over time. And second is to help people understand the benefits of a more personalized experience on Twitter. If we appropriately balance our own principles around data privacy and transparency with local regulation, with giving people a timeline quickly, with giving them a great experience on Twitter over time, we think we can, there's an opportunity for us to get more personalized experiences for people on Twitter.
It's your second straight year of turning a profit. You planning any acquisitions?
Well, we did 8 acquisitions in 2019. They were really about technology and talent. We view that as a core competency for us to find great teams that can help us accelerate our objectives and to bring them to the company. The retention of these teams for the last couple of years has been incredibly high. So we hope we can do more of those, and we're always thoughtful about where we can acquire to help us accelerate our objectives as opposed to build organically.
CEO Jack Dorsey has been talking about going to Africa to do some work over there. Are you the de facto CEO?
There's no change for us this year in how we lead. Our team is distributed all around the country and all around the world as we go out to work with our teams, meet with our partners, meet with all of our stakeholders to execute our business. Last year, Jack visited 30 of our offices. A bunch of us went on parts of that trip, but not on all of it. And so leading in a decentralized way is central to us achieving our objectives, and it shouldn't be anything different for us. Nobody has any different role this year than they have in the past.
That was Twitter CFO Ned Siegel. And coming up, Grab bought out Uber's business in Southeast Asia and is now building a super app. We'll hear from Grab President Ming Ma in an exclusive interview next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs, in for Emily Chang. Becoming a Southeast Asian super app, that's what Grab wants, with services ranging from ride-hailing to fintech and food delivery. A native startup of the region, Grab acquired Uber's business there in 2018. It has since raised billions of dollars in funding, including the latest $4.8 billion from heavy hitters such as SoftBank's Vision Fund and Toyota. My colleague Paul Allen and I spoke with Grab President Ming Ma about the firm's expansion plans.
We are obviously very closely monitoring the situation, and it is a situation that is evolving now, it seems, hour by hour. For us, though, unlike China and Greater China, which has seen the brunt of the outbreak, Southeast Asia has been largely untouched by the outbreak. Having said that, safety, of course, is of primary importance to us, and we are working with the government and the regulators to prepare contingency plans in the event that we need to take action. So everything from contact tracing, where we'll be able to notify the government of interactions between drivers and passengers, to preparing enough face masks for our driver population.
I want to switch to some of the fundamentals of the business over there. You're trying to become a super app, going into insurance and lending. What sort of opportunities do you see in that market?
Thank you for the question. First of all, I think 2019 has been just an amazing year for us. It's been a year of execution. We are now the region's largest super app. Last year alone, we launched 9 new services, from on-demand video to online healthcare services. Today, we're the largest ride-sharing platform, the largest food delivery platform. And financial services last year was really a year of firsts. We launched the first micro-insurance products, the first numberless credit card, and we launched the first bid for a digital bank license in Singapore with our partners, Singtel. So 2019 was a very, very busy year for us. In 2020, we are very focused on 2 priorities. The first is continuing the profitable growth that we've seen in our core businesses. And then secondly, continuing to broaden out the portfolio of products that we offer in financial services. As a business, we are already profitable in some of our most mature verticals. But the key for us is to continue pushing on profitability. And the way we do that is really through our B2B platform, which is really the way that we think about our restaurant partners is as a real end-to-end partner. So not just a delivery provider, but now we're providing payment solutions, procurement solutions. We're helping provide financing to help them grow their business, advertising to help you reach your customers in a more effective way. And that engagement model is how we drive greater loyalty and greater engagement on our platform.
I just want to get a little more detail on your plans in financial services. You've just purchased Bento Invest and renamed that Grab Invest. You are, as you say, applying for one of Singapore's digital banking licenses. But what's next? Are you looking at applying for licenses in Malaysia and Indonesia as well?
So first of all, it's important to understand the context. The first 7 years of our company was about solving a gap in transportation. But when you speak to our customers, what we realize is there is also a very large gap in wealth management and the ability to retire. Our customers work very hard, but many of our customers still struggle to save enough capital to have a comfortable retirement. So our acquisition of Bento was all about how do you reinvent wealth management? How do you democratize the process of personal savings to a point where accessibility and affordability is no longer now restricted to just the very wealthy, but it's available to the mass market. And we think it's a very large market opportunity. Consumers in Southeast Asia hold over $2 trillion of assets, investable assets, yet the challenge is over 60% of that still sits in cash accounts that lose value over time because of inflation. So we see the wealth management opportunity as an opportunity to create new services, new products that is better than keeping your assets in just cash. The digital bank opportunity is also a very similar opportunity. When you talk to our customers, over 40% of our customers are unhappy with their current banking partners, whether it's very expensive fees, hidden fees. You go to bank branches and wait very long times for service. We want to make banking as simple as ordering a ride. And we're very proud to be partnered with Singtel. Between the two of us, our ecosystems, we cover and touch nearly every consumer, every small, medium enterprise in the nation. And with our footprint, we are very confident we can develop the lowest cost platform for banking.
That was Grab President Ming Ma. Uber has had a rough run since its initial public offering last May. It's tackled conflicts with regulatory agencies around the globe, drawn criticism over its Uber Eats business, and faced growing investor concern about its ability to turn a profit. We spoke earlier with Uber investor and managing partner at Structure Capital, Mike Walsh, shortly after the company released fourth quarter earnings on Thursday.
I'm impressed by the fact that they're able to grow the numbers, and one thing that was great to see is that they're closing businesses, or selling businesses rather, that aren't number 1 or 2 in the industry. So they're eliminating a bunch of expenses while maintaining some equity in those companies.
They also moved up their profitability target, now looking for that Q4 of this year, full year profitability by 2021. That's a little bit ahead of targets. How much of that is the market demanding that?
Yeah, I think a lot of it. I think Dara was under pressure, and as he had committed over the last couple of earnings calls that he was planning to get to profitability quickly, and I think he's got a great team behind him that's been able to meet those objectives.
Mike, you were talking about growth targets a minute ago. Are there limits to growth, though? Because we've heard coming up in that call the law of large numbers. So does that suggest that Uber might be getting towards the ceiling in terms of ride numbers?
I think they still have a huge potential for market share. I mean, the numbers, it's still only 30% or so of the U.S. is on rideshare, or of internet users, that is, and they've got a huge global potential for rides.
Also, you mentioned Uber's been selling off some parts of the business. It sold that India delivery operation to Zomato. But we've just heard from CFO Chai saying that, well, Uber would lean in if it saw an opportunity to take a bigger position in the market. So does that suggest to you maybe they are looking for things to buy as well if the opportunity presents?
Yeah, it does. I think he clearly stated, or at least what I heard, was that the company is going to double down in markets where they can be number 1 and 2, and that may mean acquisitions in some markets.
That was Structure Capital managing partner Mike Walsh. Later this hour, we will tell you more about the company who beat Uber in China and the woman who spearheaded Didi to become the world's second most valuable startup. And this week, we got the first real look at how Disney's new streaming service is faring. We will bring you all of the numbers next. This is Bloomberg. We got our first indication of how Disney's new streaming service is faring when the company reported first quarter earnings on Tuesday. Subscribers of Disney Plus soared to 26.5 million, topping Wall Street estimates. This signals a fast start for the world's largest entertainment company as it challenges Netflix's online dominance. We spoke with Bloomberg's Lucas Shaw in Los Angeles.
They went and updated the numbers for the different Disney streaming services so far this quarter. That's something that Netflix doesn't characteristically do. So now you know that Disney Plus actually has more than 28 million customers. ESPN Plus is now above 7. Hulu grew by the smallest amount. But all told, Disney in just 1 year has become the second biggest player really in TV streaming after Netflix. You could say Amazon is bigger just because of the number of Prime customers, but we don't know how many of them are actually watching video. So let's say Netflix still far and away the biggest, but Disney with really impressive growth and strong viewership based on some of the data that Bob Iger shared about the popularity of different shows and how long people were watching on a weekly basis.
How about the costs, though, because it's expensive to make all this wonderful new content? How is that looking for Disney?
I mean, it is no question that it's a major investment for them. The losses from the Disney streaming or the direct-to-consumer unit rose significantly, I think north of $600 million in losses. But that's kind of to be expected. I don't know that investors are going to be too worried about that because, look, this is the game that Netflix has been playing for a very long time. the bet is that in the long term this will work. One of the reasons that Disney moved into streaming was because it needed to show investors and that it had kind of a growth opportunity going forward. Cable TV, along with theme parks, but especially cable, had been such a growth engine for this company, and it needed to kind of direct investors to a new area that would be that moving forward. The direct-to-consumer business grew from, I think, 900 million to 4 billion, something like that in this quarter, year over year. That's just really staggering growth, almost as much as Netflix grew overall as a company last year. And that's something that Bob Iger can point to and say, this is the future. Now, long term, they are going to need to get the costs under control. They've forecast, I think, by 2024 that the division will be profitable. So they have some time to figure that out. We don't know if it will be profitable, but I think investors will give them a pass in the short term.
That was Bloomberg's Lucas Shaw. Wall Street watchers have been scratching their heads over Tesla shares since the beginning of the year. As you can see, the stock has been on a tear. On Tuesday, Tesla closed at a record high of $887. That was before pulling back later in the week. Portfolio manager Steve Eisman told Bloomberg this week that the recent run-up in the electric vehicle maker stock is inexplicable.
Look, everybody has a pain threshold, and when a stock becomes unmoored from valuation because it has certain dynamic growth aspects to it and has cult-like aspects to it, you have to just walk away.
We also discussed the recent moves with Tasha Keeney, analyst at ARK Investments.
Investors might be worried about coronavirus, but I think that's a really short-term focus. At ARK Invest, we're long-term investors, and we actually just put out our latest research on Tesla. We think over the next 5 years, our expected value for the stock is $7,000, and that's because it's a leader in electric autonomous vehicles, and that's the future of the auto market. And what we've seen over the past year is that traditional autos have really struggled to produce EVs that are on par with Tesla's cars, and its data library in terms of autonomous driving is really just running away from the competition.
So, yeah, 7,000, that's a very impressive prediction and a long way from where we are now. So does Tesla really have that much of a head start on battery technology? Because it ships far fewer cars at the moment than established automakers.
Yes, well, in electric vehicles, Tesla is the leader, and that's because they're riding down the battery cost decline curve. So at ARK Invest, we've actually done a lot of work using Wright's law to predict the future declines of batteries. Basically, for every cumulative doubling in production, you get a corresponding reduction in cost. So if you look at Wright's law, we actually think that Tesla's gross margins could go from, say, around 20% today, if you take out credits, to up to 40% in the best case scenario. And they also have not lost share in the electric vehicle market. They're sitting right around 18% share. So we think that they're at least 3 years ahead of other automakers on a battery efficiency standpoint. So that's dollar per range that you get out of the car. And then on autonomous driving, they're the only automaker that's collecting data from their vehicles. This gives them a massive advantage in terms of training their machine learning algorithms to get the car to drive.
Besides the advantage, Tasha, how do you get to fair value of $7,000 in the next few years? You have a path from $734 now to $7,000. How do you get that fair value number?
Well, we've actually we've devised a probability matrix, and this is all on our website, this research, where basically we've looked at the past year. We've seen what Tesla's done in Shanghai. It's amazing. They've built the factory in less than a year, and they're right now shipping cars. Tesla's shown that they can scale in a capital-efficient manner. So we look at a few key variables. We look at capital efficiency, gross margins based on our Wright's law work, and autonomous driving. And we set probabilities to each of those that helps us arrive at that $7,000 mark. And our bull case is really driven by autonomous driving. This could be a huge opportunity for Tesla. It's going to totally transform the business model if they pull it off. They're going to get software-like margins in a market that we think could be worth trillions of dollars globally.
Tasha, Steve Eisman of The Big Short told us this morning that the stock is no longer trading on valuations. He had to walk away from his short positions. What do you do with a stock like Tesla when it no longer trades on valuations?
Well, I think Tesla's been misinterpreted for a long time. One, on the autonomous driving front, I mean, we're really only hearing sort of this story be a more common theme in terms of what people are talking about for Tesla. And you can't value it like a traditional automaker because the future of the auto industry is changing. Electric vehicles and autonomous vehicles are going to make this a more consolidated market. A lot of automakers are going to go out of business, and Tesla's really in a great position to take advantage and be the leader of the future. So again, if you look at autonomous driving, that means software-like multiples, because we think they'll get software-like margins off of that business.
That was ARK Investments' Tasha Keeney. Coming up, one of the most powerful women in tech, how Jean Liu led Didi Chuxing to victory against Uber in China, and more. We'll explain the story next. This is Bloomberg. With a valuation of over $50 billion, Didi Chuxing is one of the most high-profile companies in China. The company's president, Jean Liu, helped it drive Uber out of China and expand beyond the border. We take a look at how she became successful in a country where women aren't always seen in the C-suite.
Jean Liu is one of the most powerful women in tech. She's the president of Didi Chuxing. The company operates one of the world's biggest ride-hailing services, completing up to 30 million rides per day. That's about 10 million more than Uber. Didi is also the world's second most valuable startup, with a lofty $56 billion valuation. But Didi's valuation has been called into question following Uber's disastrous IPO. Didi shares are said to be trading privately 40% lower than their peak. Investors are starting to doubt if car-hailing companies can ever turn a profit. This is how Jean Liu took on Uber and made Didi one of the most high-profile companies in China. Liu was born into a prominent family in Beijing in 1978. Her father is a Chinese tech icon, Liu Chuanju, the founder of Lenovo.
Jean Liu strikes people as a type A personality. I think part of it does come from the fact that her father is one of the most famous people in China, and she's been trying to make a name for herself.
Liu majored in computer sciences at Harvard and spent 12 years managing Asia investments at Goldman Sachs. In July 2014, she joined the then 2-year-old startup Didi, aiming to help solve China's massive traffic problems.
Right after I joined Didi, there's this woman coder coming to my office saying, I want to resign. Asked her why, and she said, I got pregnant. I said, you can still work here if you get pregnant. She said, no, it's the commute that's killing me. And, she was spending 3 hours switching between buses and subways every day. There are many, many people like that in China, 800 million Chinese that rise 1.4 billion times every day.
Liu brought her financial expertise to Didi. She helped the company raise billions of dollars to compete against Kuadi, its largest local rival, and later brokered a merger with them. Months after the completion of the deal, Liu was diagnosed with breast cancer. She survived and returned to work to face one of the biggest battles of her career. Didi was facing its strongest competitor ever, Uber, which was already big in the US and starting to expand globally.
Uber came when we were 3 years old, and the war chest, the money they brought in was bigger than our market cap. So we were scared for a moment, and there was a big decision whether we give in or not.
Didi didn't give in. Instead, Liu and her company fought an all-out battle against Uber. The two companies spent billions discounting rides and recruiting drivers in an attempt to crush one another. Gaining market share turned into a question of who had more money to burn.
First of all, we worked really hard. The product team stay in the office, for 3 months. They sleep in the office, and we roll out 4 product lines after Uber came in. And secondly, we think we understand the market more.
For example, many of China's cities restrict the use and ownership of private cars as a way to manage traffic and pollution, so Didi focused on taxi hailing, but Uber didn't seem to understand that. Didi also had the support of China's 2 mobile payments giants, Alipay and WeChat Pay. They helped smooth transactions and also backed Didi subsidizing its drivers. A year later, both Didi and Uber realized that they had to stop the costly war and concentrate on building their businesses. In August 2016, Didi bought Uber China after receiving $1 billion of funding from Apple, a deal largely brokered by Jean Liu. Uber also acquired a small stake in Didi, retreating from the Chinese market. Since then, Didi started to dominate the domestic market.
Jin Liu was instrumental in brokering the Apple deal. When she met Tim Cook, she was saying that Didi's logo is an orange, and Apple being another fruit company, they were bound to do great things together. 22 days later, they announced that Apple was investing $1 billion into Didi.
While Didi triumphed over Uber in China, they soon began competing globally. Didi has entered markets in Latin America, Australia, and Japan. It now completes an average 4 million rides a day outside of China. It also launched proxy wars against Uber through investments in many of its international competitors, such as Grab, Uber's biggest competitor in Southeast Asia, and Lyft, the main Uber rival in the US.
Didi and Uber have a pretty interesting relationship. After the merger, they did have this short period of truce, and they were observers on each other's boards, but that has come to a halt right now. Didi did form strategic alliances with Grab, Lyft, but it hasn't been working as closely as people envisioned.
And just like Uber, Didi has ambitions beyond ride-hailing. It's venturing into on-demand food delivery, bike and e-bike sharing, smart city solutions, driverless cars, and the lucrative car financing business that Jin Liu helped to build. But those ambitions may be kept in check by a year-long company overhaul triggered by the alleged murder of 2 female passengers. The company's safety record was thrown into the spotlight as thousands of users publicly deleted the app. Regulators cracked down on the type of drivers and cars allowed on Didi's carpooling service Hitch.
我自己生病的时候，他就是一种稍微有点焦虑，还有点遗憾，有一点恐惧啊。当然肯定还是有一点恐惧的，就哎呀，对吧？就是要面对死亡嘛。但是远远没有去年的这件事情给个人的这种打击大，那是远远没有的，因为。
It was a huge setback for Didi. At the time, it had to halt its carpooling service. It was a very lucrative business for the company, and after that, it went through a series of revamps, trying to step up its security measures. They finally resumed that service last year.
Despite Liu's success with the company, helping grow it into a massive startup with about 13,000 staff, there remain serious questions about the business. The company is said to have lost $1.6 billion in 2018. Investors are doubting if it can ever turn a profit. It faces stringent regulatory crackdowns and competition from regional operators, even after muscling Uber out of China. The outbreak of coronavirus in China could also dampen Didi's prospects, as the government has imposed travel restrictions between many cities, and people are traveling a lot less within cities.
It's another make or break year for Didi, and a lot of Jin Liu's legacy depends on whether she can prove that Didi can be a profitable company in the long run.
That was Jin Liu of Didi Chuxing. And that does it for this edition of the Best of Bloomberg Technology. We'll bring you all of the latest in tech throughout the week. Tune in each day, 5 p.m. New York, 2 p.m. in San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.